So welcome to this week's episode of Leaders on a Mission, where I am joined by inspiring leaders driven by the impact of creating a healthy and sustainable world. And in today's episode, I'm joined by Eric O'Brien, co-founder and managing partner, director of Farmland Capital. We're a prominent and leading investor focused on farmland and agricultural technologies. And Eric, it's super appreciative of your time. Thanks so much for joining me on the show today.
Simon, it's my pleasure. Thanks for having me.
And tell me, Eric, we're taking it all the way back, early upbringing. What were the key forces you think in helping shape some of those really important ideals and values of yours? Where did they come from?
Oh, I have to assign the 90% of those values to my parents. So I grew up in San Francisco. My dad and mom were both born in San Francisco. My mom's family immigrated from China, and my dad's he's probably second generation San Francisco. Very middle class upbringing. My dad was a podiatrist. My mom worked in my grandmother's Chinese restaurant in Chinatown of San Francisco growing up. And then eventually she was a stay-at-home mom for most of my childhood. And then she became a professional caterer a little bit later on. Just the most hardworking, high integrity people you could imagine. They sacrificed, everything for my education and my brother's education. I have a younger brother. And, just everything was about hard work to achieve goals, delayed gratification, all of those ideals that I think I'd love to impart to my kids, and it's much harder to do that these days. And so I really appreciate where they sacrificed for us. And so growing up in San Francisco, they were very much kind of middle income folks, and sent me to private school in San Francisco because the public school system for kind of kindergarten through eighth grade was a little bit lackluster. And that was a big financial sacrifice for them. And then I ended up going to Lowell High School in San Francisco, which was a public high school, but it was a magnet school that you had to apply to get in. And it was all the smartest kids in the city were there. So that was an environment that was very enjoyable, but it was incredibly competitive. And from there went to Harvard. And the formative experiences, I think, through high school for me weren't so much the academic ones, but more the athletic ones. So I ran track and cross country, and then I rode crew for 3 years. And that in particular, that experience of 4:30 in the morning workouts followed by 4 p.m. to 7 p.m. workouts 5 days a week with races on weekends, that kind of discipline and hard work and teamwork. So some of those individuals in my boat are guys that I stay in touch with very closely to this day. So I think it's that combination of the family upbringing and the competitive discipline of athletics that have been probably most formative to me.
Great, no, that's lovely to hear. Tell me though, with that, when you were growing up at the time, you speak about the sacrifice. Were you really aware of that at the time? And does that make you kind of a little bit more focused and hardworking, because you know what they're giving up?
Yeah, that's a really good question. I think varying levels of awareness as I grew up. I perceived it actually negatively as a little kid going to private school in Pacific Heights in San Francisco, where everyone was being driven to school in Volvos, Mercedes, and BMWs, and my mom drove the Chevy Nova, and the other kids in our carpool were embarrassed to be in it with us, and I was embarrassed to be in it, and so I realized that we didn't have what the other kids have. You could argue that that's probably also one of the drivers from kind of an early stage. And then as I got older and began to kind of understand sort of the relative situations, and in particular when I was looking to go to college, and when you are staring down the barrel of what college really costs, and then understanding how that's going to impact the family, that's when I think it really sunk in that, you know, they were putting themselves aside to give me what, you know, they thought was best for me. So that, I think it was at that point that I truly appreciated it.
Yeah, no, great. It's a lovely story. You know, it's great, isn't it, when you see that and you really see the, you know, what people have actually gone through to, you know, for you to be able to get to where you've got to. And tell me, at that time, was it banking? I mean, when you were thinking about career, as it were, I know you did economics, wasn't it, as it were? So yeah. I suppose, you know, what was your at that time, around that time, what was your vision and, you know, context? Where did you see yourself?
So in the eighth grade, I remember this very specifically. I had an introduction to economics class in the eighth grade, and we had just a phenomenal teacher who left such a mark on me that I just had this bug around entrepreneurship and business that made it relatively straightforward for me to choose economics when I went to Harvard. I didn't, because my parents, didn't have my parents were both the first in their families to go to college. And so we didn't have a community around us of folks who had been really university educated. And I didn't have much in the way of mentorship around this. So my context was, well, what's the most competitive thing to do? What are all the smart kids doing? And at the time, the job that everyone wanted coming out of undergrad was either banking or consulting. The tide turned on that, you know, a couple of decades later. But you know, when I was coming out in the early mid 90s, that was the hardest job to get. So that's what I wanted. And that is what led me to Morgan Stanley. And I spent 2 years there in the analyst program, 1 year in New York, doing mergers and acquisitions in telecom and media, which was at the time reputed to be the hardest group to get into. So I wanted that, like that's sort of one of those kind of constant drivers with the lack of context that I had and the lack of mentorship that I had. That's sort of all I knew. Like, well, what's the hardest thing to go do? I want to go try to do that. And you know, in retrospect, I don't regret any of it because it was a tremendous training ground. And, you know, in those kinds of programs, you get 4 years of experience in 2 because you're effectively working 2 weeks for every 1 week of real time. So it was great. I wouldn't change it. But I think if I had a little bit more perspective, a little more mentorship, it's possible I would have gone in a slightly different direction.
Yeah. Okay. And well, nowadays they're all coming out wanting to get into clean tech and agri-food tech. So it's, times have changed. Yeah. Exactly. You know, it's interesting. We're, you know, moving ahead 12, 13 years. I mean, where did the connection with agriculture, farmland, you know, when did that kind of circle in to the the context of your career, as it were?
I think the thing that that links most of the sort of, at least the later elements of my life, both on the business side and the personal side, revolves around relationships. And that's where the connection came. It was through my relationship with Clay Mitchell, my co-founder at Farmland. So that goes back to sophomore year at Harvard when he was a freshman, and we both were on the Harvard ski team. And so I met him as a freshman, and God, we hazed the crap out of that kid. And he was just such a fun, good sport. But, you know, he was the farm kid from Iowa, who spent his winters, because grain farmers get their winters off. He spent his winters with his family skiing in Colorado, and he became a pretty darn good skier. And so we, you know, skied together competitively for 3 years. And we never thought we were going to end up working together. He's a fifth generation farmer from Iowa. He was studying biomedical engineering as an undergrad, and then he went and got his master's in agronomy from Cornell. So this guy always knew he was going to be a farmer. I had no interest in farming. I knew nothing about farming. Clay was my link to farming. So that, kind of parked that at graduation, and we would get together in the ensuing years during the wintertime and go skiing together. And what I observed was that his career was just taking this incredible turn because he had been so introspective. Like everything that he did after graduating was focused on making his farm in Iowa the most productive and most sustainable farm that one could imagine. And it wasn't sustainability at the time for the reasons that we're looking at sustainability now, right? In terms of saving the planet, because, back then, and we're talking, 1996-7 timeframe, climate change was not really on the radar screen. Clay's observation was that farmland, the way it was being farmed, so heavy tillage being one of the predominant practices across the Midwest, was effectively destroying farmland centimeter by centimeter over a period of decades, and no one was noticing. But if you could apply better operating practices and technology to solving the problem, you could keep the topsoil in place, which is the most important thing. You could farm it without tilling it, and you could get high productivity. So his career is taking off doing this and refining all these really interesting technologies. He's forwarding me emails with articles about him written in the Financial Times. He had multi-page spreads in Wired magazine. He emailed us, a group of us one morning because he was at the World Economic Forum, and he was 15 minutes out from meeting Ban Ki-moon, and he was asking us what he should ask him about, because he was, Clay was invited as a rep for U.S. agriculture and kind of world agricultural practices. So I'm kind of observing him doing his thing while I'm doing my thing in venture, in the tech venture business, and the paths never would have crossed, but for the fact that I began to see some ag tech deals come into Silicon Valley. And I remember, there was a company called Oasis, and we didn't end up investing, but it was sort of a product that would ideally hold moisture in soil in fields. It was a soil additive. So I'll call Clay about this thing. And so I called Clay, and he quickly disabused me of any notion that this was an interesting technology. And then we began to see a few more. So I started to get Clay involved in looking at anything that had to do with ag. So that was kind of 2008-9 timeframe. And in 2010, kind of end of 2010, I was presented with an opportunity to invest in a land fund, a farmland fund, by one of my financial advisors as a diversifier outside of my pretty tech-heavy portfolio. And I asked Clay to look at it with me, and we started to kind of look at that opportunity, and then we just looked at the space in general. And I think the thing that occurred to us was, it's a pretty interesting asset class, and it is incredibly underpenetrated from an institutional perspective, kind of like timber maybe 40 years ago. And at the same time, I was beginning to hear from LPs in Lightspeed through interactions at annual meetings and so forth, that they were spending time looking at real assets and increasing their exposure to real assets. And so the light bulb that went off for us was, what we observed was the mainstream players in farmland, to the extent that there were banks and insurance companies that were taking a very beta-oriented approach to buying and managing farmland, which, for a long time was just a good strategy. You buy farmland, and it was kind of appreciating because of the rise of ethanol and productivity, spreading outside of just the Corn Belt into other areas, and that was making land more valuable. But they weren't really doing anything with the asset. Fundamentally, they were outsourcing it to third-party farm managers, and they were just collecting rents. And our observation was, if Clay, if you did what you do on your farms, to all these other farms, not only would they become better, more productive farms, but they become a lot more valuable. And if we could leverage technology to accelerate some of that, there could be something interesting here. And that was kind of the turning point this was 2011 timeframe, where we started brainstorming together. And then, separately within Lightspeed, I was the fifth partner, outside of the four founding partners. And then there were another probably 4 or 5 partners who had become partner after me. And, it was a situation where those were the founding partners. They were always going to be the founding partners. And I was never going to be a founding partner. It was just that's the way it was. And so at some point I knew I wanted to do something on my own. I wasn't sure what it was going to be. So this is a long answer to your question, but it's a combination of relationship and serendipity, and the timing seemed right. And it seemed like there was this gleam in the eye of the institutional world that farmland was something of interest, and technology we knew was going to play a role. We weren't sure how it was going to roll out relative to our strategy. So at the outset, we were all about farmland. We carved off just a little bit of that fund. We convinced our LPs, hey, take a flyer on our understanding of the domain, technology, and technology investing, and let us leverage our domain expertise and venture expertise to back a few companies in ag tech that we think could be synergistic with what we're doing on the farmland side. And then, let's see what happens. And that was the start of it.
Oh, I love that. Thank you. I bet it was a very different kind of conversation you were having when it came to investing and the investing thesis. And you look where we are 10 years on, basically.
Yeah.
Like where it is now, it must have been some journey, right?
Well, it is. This is the first time in the market that we've actually achieved the commodity prices from when we raised the fund. So we have lived, like, the 10 years that we built this fund have been like the 10 worst years in agriculture in the last 30. So we have been, and I think anyone in the industry, particularly on the farmland side, maybe not as much on the ag tech side, because you don't see the cycles as clearly as we do when you own the land and you live by the cash flows from the land and the commodity prices. When we raised our first fund in 2012, corn hit an all-time high of $8 a bushel in June of 2012, and that was when we were in the heart of raising our first fund. And within 18 months, corn was trading at 3, and then it proceeded to trade sideways between 3 and 4, sometimes into the 2s, for the subsequent 6 or 7 years. And we sort of had to really work on our investors to let them know, hey, look, this is the nature of the ag market. It's cyclical. There are things that we can do when times are lean to make farms perform even in difficult environments. But you're just not going to get the upside volatility when prices are this low, because some of the things that we can do to make farms more profitable, more productive, have marginal costs associated with them that doesn't make sense to pull those levers when corn's trading at $3 a bushel. But keep the faith. When corn comes back, when it pops over 4, we begin to pull some levers. When it goes over 5, we can pull a lot of levers, and anything above that, there's just a lot that we can do. We just didn't have the chance to show that until really last year, and a little bit the year before that. And so the market has now finally come out of that down cycle, and we've been able to show some of the positive volatility that we can create on the production side and the profitability side. And suddenly farmland is cool again. But it's been a long time coming.
Wow. Yeah. And where's it trading now, for instance, a bushel of corn, for instance?
Yeah, it's trading in it's getting close to those all-time highs. It's been in the 7s and up.
Very much driven by the Ukrainian kind of issue.
Well, it's a combination of things. Actually, it was rising prior to the conflict, and that has definitely exacerbated things. But I think a combination of weather issues around the world. So there's been some and looking back at 2012, that spike was really driven by sort of a 12-year drought across a good chunk of the U.S. and that was a big spike. But it also at the time had some underlying demand drivers that were at the time when we were underwriting farms at $8 a bushel. Our downside scenario was $5 a bushel as we were underwriting commodity prices for cash flows on the farm. And we never thought we'd get there. And we blew right through it. And on this time around, we're seeing demand dynamics and supply chain issues of creating crop scarcity. And we are, seeing this year potentially some input shortages affecting crops, and we're seeing some weather-related issues in South America creating some shortages. So those were all driving crop prices up. And then the world's largest wheat producer invaded the fifth largest wheat producer. And that has, I think, fundamentally shaken the market for what could be, we think this is, potentially decades of effect. And not just because of the discrete loss of crop from those two producers, but because of what it does to, the sort of deglobalization concept and increased scrutiny around food security. We think those are things that definitely accrue to the benefit of U.S. farmland. And then add to that, what's happening with inflation, and we're seeing investors looking for things that have inflation protection built in, and that's one of the things that everyone kind of talks about farmland for, because you're growing commodities, so therefore you've got some inflation protection, and I think statistics would show that during periods of high inflation, farmland actually outperforms commodities in that regard.
Yeah, fascinating. Tell me a little bit about the fund in terms of, you said you raised the fund in 2012. Like how big was the fund, and how, give me some context about numbers of investments, for instance, that you've made, and the profile of the fund over the last 10 years.
So the first fund was $125 million, and it was a standard private equity closed-end structure with a private REIT underneath it, so private real estate investment trust. That's what holds the farmland, and then the fund also had 5% of that 125 available to deploy into AgTech deals. So those were done traditional venture style investments, preferred equity, minority interests in private companies. And that, we began investing, we did the first closing in 2012, final closing in the first quarter of 2013. And we invested that over the course of the subsequent 3-ish years.
All in the US, yeah? All in the US?
All US in that first fund. The farmland has always been US, and over time we have begun to expand with investments on the AgTech side internationally. So that first fund had, we began investing in 3 main regions of the US, which is where we continue to focus. So the Pacific Northwest in Eastern Washington, Oregon, Idaho. We have a little bit in Montana, and then northern Wisconsin. That's kind of our Midwest play, but it's sort of out of the Corn Belt, Midwest, where we think we see more opportunity to add value. And then down in the South in Arkansas, Louisiana, and Mississippi. So those are the 3 regions that we began investing, and that's where we continue to invest. We invested with our second fund, and now with the new funds that we're currently just wrapping up raising.
Got it. Okay, so you raised a second fund, and now you're on third. You're trying to close third.
Yep, third and fourth actually.
Okay. Oh, really? Okay. It's interesting.
Yeah.
And no, it sounds like it's been some journey. And tell me when you consider and you think about deploying technology. You spoke a little bit about investing in kind of AgTech. What would be the kind of, I suppose, real technologies that you've you've seen that have made a real difference on the farm in that time?
So we look at deals with the lens. One of our core filters is, can these technologies that we're looking at be synergistic with what we're doing on the farmland side? So that's one key criteria. Or maybe they aren't necessarily directly relevant today, but do we see how that technology informs how they could approach our markets? Or do we have expertise based on our experience that could significantly help these companies and build value in those companies? So some of these we know are likely to be products that we're going to want to use on our farms. And in other cases, we have some insights about the market that we think are going to be helpful to those companies. Can our production capability be useful to these companies? And that relates oftentimes on the food side of what we do. So, over the years, we've become some of the largest customers of some of our companies. High Fidelity Genetics is a company that produces, among other things, non-GMO corn seed, and we've become one of their largest customers within our Midwestern or Wisconsin farms. They've been big buyers of that seed. We use Sound Ag's products, a product called Source, across probably about 80% of our farms. When we invested in Planet Labs out of our first fund, we were, I think, maybe their very first user of that satellite imagery for ag purposes, so making decisions in field. When we became an investor in Granular in our first fund, we started out, we discovered them because we were looking to become a customer of a farmland ERP system and did a pretty broad scan of the market and tested a number of products. And they were the one that we thought was the best. And as part of becoming a customer, I approached Sid Gorham, the CEO, and told him that we thought, we could be helpful and we'd like to invest some capital, even though they weren't actively raising in the market. And they took some money from us in a convertible note, and that ended up working out really well for us. So in fact, we just had a quarterly strategy meeting with our own team internally. And one of the things that we try to track is, okay, what are the trials that we're running on our farms? Which of our companies are we actively taking into the field? And what are we doing from a diligence perspective in terms of areas where we are most curious about new technologies, and are we testing them out? And we had a list of probably 40 different companies and products that we are trialing across the farm, across just a wide variety of indications and issues. So it's something that we take very seriously, and it's something that we run as a single team, inclusive of both the farmland and the ag tech side of things. So everyone knows what's happening within the firm. And even though you may be a farm manager in northern Wisconsin, spending 80-90% of your time working with our farmers or sourcing new farmland opportunities, every company in our portfolio, what those companies do. And when those companies want to come out into the field and either run a trial or meet some farmers and get some customer feedback, those are the people that are taking those companies into the field. And conversely, on the ag tech side, we've got some individuals, a VP and a senior associate, who are spending 80-90% of their time bird dogging new deals. So covering the waterfront of everything that's going on. They have the context of everything we're doing in the field, and they know what the priorities are. And so it really helps guide us proactively toward themes that we think are the most relevant.
Yeah, absolutely. And what are they? I would imagine that some of those relevant themes, they've probably really changed over 10 years, right? Maybe just give us a view on, if you go back then and you look now, what have been maybe the top 2 or 3 things that have really evolved when it comes to the farmer's need, as it were?
I think some of the starkest examples would be, when we first started this whole concept of aerial imagery, right? Drone-based imagery, satellite, airplane. It was this new and novel thing, and we bought several drones ourselves to try to fly them around and see what we could do with them, and there was this fascination with drones and aerial imagery. That turned out to be not a particularly good investment market. There were quite a large number of drone-based aerial imaging companies. Most of them are gone now. There are a few that remain. The satellite companies have actually gobbled up a lot of that market because the marginal cost of a bit, a pixel, has gotten so low from a satellite perspective, and the resolution has gotten so high that it's made other forms of imagery a lot more difficult to be profitable. And imagery itself has become a commodity. So that it is also one of the most profound technology advancements that we've seen in the last 10 years. So while it didn't necessarily spawn awesome businesses, I think Planet Labs is an exception to that, having gotten public last quarter. The imagery itself really is essential to how we manage farms now. The question is, well, okay, well, where's the value in that? The value is in the analytics of that. And even then, we have yet to see companies that have kind of gotten escape velocity on making decisions for us. We're still making those decisions. So the imagery is really important, but we never saw a super outsized winner in that space. And so then, where does that go? I think sort of part of that evolution has been toward using imagery in different ways. So computer vision now is something that has progressed to a point where it's no longer science fiction. These we see it. You see with Blue River being acquired by Deere. They were early pioneers in using computer vision for lettuce thinning, and Jorge Herrad, the CEO there, is a great friend of ours and an investor in our fund. And we missed on that deal. We looked at it 3 times, and our view was that it was just going to take too long to get to broad acre crops. It was going to be kind of stuck in high value, smaller crop markets. I think what we missed there is that, groups like John Deere looked and said, yeah, no, this is the future. We need to have that technology. And so they were willing to pay for a team. But now I think that technology has advanced to a point where not only can you see these things in real time fast enough to make decisions, but then you can actuate and then do things that can scale to broad acre field levels. And so we just invested in a company called FarmWise that we think is got a really interesting combination of computer vision and robotic capability to take that to the next level. And so we're seeing more and more sophisticated hardware taking advantage of all the advancement that we're seeing in Silicon Valley with respect to robotics and AI. It's a big leap to take that into the field. That's one of the big areas of underwriting scrutiny that we apply, is sort of how well does the team understand the problem set when you move into a farm. It's far different than in a street environment. It's far different from like a warehouse environment where we're working on solid ground, and the major objects don't move. In the farm environment, everything is moving all the time, and the conditions of the surfaces change based on weather and daylight and wind and so forth. It's and there's ground engagement, which is very different from a lot of machines, and so that's where I think that we've got multiple people on our team who have more than 10,000 hours behind the wheel of all the major farm equipment, and so they really understand, combined with Clay's background in engineering and some of our other engineers on staff. We can see we can separate what we think is going to be practical and what we think is going to be stuck in theory for too long.
Yeah, well, you really bring, it's funny, when you're making investments into technology, you're really bringing the farm view, essentially, from an application viewpoint. And I'm sure everything you're investing in has been, tried and tested from a view of real kind of viability, as it were.
Yeah, that's one of the things that I think differentiates us and makes us a valuable member of a syndicate. Right, we bring a perspective that's very practical. If someone says they can do something in the field, we say, great, let's go do it together. And we can actually trial things during the diligence process, which not many firms can do, and that our our perspective and what I try to communicate to our team when we interact with startups is that we want to make the underwriting process valuable to both sides. We want to learn a lot, and then we want the companies to learn. And maybe they're going to learn something that leads us to not invest, but that's okay. We want every company that interacts with us to walk away feeling glad that they spent time with Farmland. And that's also one of the things that I think gives us more degrees of freedom as we interact with companies. We may not invest, but it doesn't mean that we still couldn't be a customer of yours down the road. And we have examples of companies, a recent deal called MicroPep, where we passed on the Series A. We had some questions about efficacy, and this is a micropeptide company. It's a crop protection product.
In France. Yeah. Tom,
I know you're familiar with them.
Yeah.
They were on the verge of doing some field trials. And we decided to pass and wait and see, because we had some skepticism about whether there would be efficacy. Well, they got the data back and it was good. So, surprised us on the upside. And we came back to them and said, hey, this is good data. We'd like to invest. And so, they took capital from us, at a slight markup to the last round. We feel good about having turned that card over and seen the data from us. From our perspective, there was risk reduction that occurred, and we're willing to pay more in a situation where the risk has been reduced. And for them, it was validation, and they got a nice little markup in a short period of time. And now we're pressing forward together and seeing how we can help them as they move from France to the US.
Yeah. Okay. No, that's great. That's great. Tell me, from a viewpoint of, we touched upon sustainability earlier, for instance. No doubt the dynamic around the fund and what you're looking to achieve has probably evolved and changed as it relates now to, climate change and population growth. How do you, what is the focus, and how do you view the kind of challenges that we face, from a viewpoint of feeding the world?
Yeah, well, there's two, I think, we tease about two elements of what you just mentioned. So can we feed the world, and can we do that sustainably in the context of climate change and ag's impact on that? To the point of feeding the world, I have very little doubt that we'll be able to adequately feed the world. I think that the challenge is distribution. We can absolutely create enough food. Can we get it to all the places on the planet that need it? That's going to require more concerted effort. But I'm not worried about the aggregate quantity of food that we could create. I think we are nowhere near saturating the yield potential of even U.S. farmland, much less other parts of the world. So, and I have very high faith in technology's ability to continue to take us closer and closer to that asymptotic kind of yield upper limit. I think the question is more along the lines of, from a sustainability and impact perspective, what is ag's contribution to greenhouse gases, to climate change generally? I think there's growing realization that, hey, half the planet's habitable land is used for ag. We see a future where farms are potentially regulated like point source polluters, and so but there also may be carrots to drive incentive, behavior along the way with respect to carbon credits and things like that. So whether we are given incentives to reduce greenhouse gas footprint, or we are given regulations, they're going to force us there. Change is coming. I think that's for the positive. And that's sort of an effort that we have really taken from something that's been core to our ethos from the beginning, and we've become much more articulate about it today. When we think back in 2012, when we were raising our first fund, if you were talking at that point about having an impact initiative, that was sort of code for concessionary returns. And so, you just didn't want to talk about it because it sort of, it hurt your message in terms of how strong the underlying investment thesis was. But from the beginning, this whole concept of soil sustainability, right? If we can keep the organic matter in the soil in place, that's the single biggest lever that ag has to prevent further climate change, right? Tillage and soil erosion are releasing massive amounts of carbon into the atmosphere. And so our single biggest lever as an industry is just to stop doing that. So no-till practices, are core to, our thesis from a management perspective. And then everything we look at with respect to technologies that we think are going to be synergistic with the farmland management objective are all about keeping carbon in the soil, trying to sequester more of it to the extent that we can into the soil, and increasing our resource use efficiency. So how do we do more with less? So if we can be more accurate with how we are placing seed and fertilizer and crop protection, then we don't need to broadcast these things, which means we get to use less of them. And the more accurate we are in the field, the less we are compacting soil, the less we are doing things that have knock-on effects that sort of drive a lot of these negative externalities. So that all of those things kind of are well aligned with our economic goal of maximizing profitability and value of the farms. The more productive we make the farms with less inputs, the more profitable they're going to be, and hence the more valuable the land is going to be. So there's a really tight alignment between the economic goals of the fund and the sustainability goals. But the world has evolved to a point now where I think understanding in a more overt way, what are the things that we're doing to be sustainable? What are the things that we can do to have positive impact? Those are now front and center, and investors are demanding both economic returns and sustainability and impact mandate. And I think that's the biggest thing that we've seen evolve in the market over the last 5 or so years. And for us, having been a Farmland and AgTech combined fund in Fund 1, and then in Fund 2, we increased the allocation of AgTech. And so now as a firm, we're almost 50-50 in terms of total assets under management between Farmland and AgTech. We have decided to split the strategies into 2 separate funds because investors have a hard time grokking a single pool of farmland risk return relative to venture risk return. And so we are now giving investors the ability to choose and titrate their exposure to both strategies individually. And what I would say is that in particular on the AgTech side with our new AgTech fund, I would say the majority of our new LPs are impact and sustainability oriented investors. And that is a core part of why they're investing in us.
If you were to compare, you look at both sides of that, right? You've got the investing in the farmland and you've got investing in the technology. Clearly, valuations have gone crazy on the AgTech side, right? I take it that's a lot more volatile and high growth as opposed to the price when you're trying to do deals with farmland.
Yeah, there's clearly a complete just difference in risk return profiles of these 2 asset classes. So, farmland, has an element of volatility with respect to commodity prices, but that is substantially dampened when we look at farmland values. So farmland values do not fluctuate anywhere near the way you would expect venture values to fluctuate. And it's just that the whole nature of that asset is a very stable, you can think of it almost as a long-term sort of infinite series of call options on commodity production. You can't actually buy commodities that far out. Like if you have a long-term thesis on scarcity of food, you can't play that with respect to commodities because commodity markets only go out a couple of years, in options trading. So the way you can make that bet is by buying farmland because every season you can produce a crop. And with row crop farmland in particular, every season you can produce, any one of a number of crops, and you can make that decision. So it has a level of stability associated with it that you don't get in a venture-backed, startup. And consequently, pricing relative to yield, it's just a far more conservative investment. And our lens on that is how do we actually inflect the cash flows of that asset up by doing things proactively to make the farms more productive. On the venture side, absolutely different risk return profile. You never expect to lose all your money on a farm. that is just that's not in the option set when you are underwriting a farm. If there's a risk that you lose all your money on a farm, that's not a farm you want to buy. you may lose all your money in any given venture investment. And if you don't have a few companies that don't make it, you're probably not taking enough risk. What we have seen is that valuations at the seed and the Series A have not been as wildly volatile as they have been in the Series B, C, and D and later companies, and not nearly as increased or elevated in valuation as we have seen in mainstream venture. I still have lots of friends in mainstream venture firms who are doing seed and Series A deals at pricing that it's just incredibly hard to grok, where companies must be exiting at north of $10 billion valuations in order for you to even remotely get a venture return. When you're starting with that level of pressure for exit at a valuation set in the seed or Series A, that's a difficult situation to be in, particularly now as we move into potentially down cycle. And I think there are a lot of younger investors out there who haven't lived through one of these. I've been through a few of these cycles now. I've actually, in my prior life, I've had to cut a clawback check, where you got paid a carried interest gain, and then the fund later, underperformed relative to the carry it had taken earlier, and you've got to pay LPs back for the profit that you took on an after-tax basis. Sorry, you have to pay a pre-tax check back, even though you've already paid tax on the gain. That is the most painful check to write. And it sears in your memory, the pain of what getting out ahead of your skis does for you. And that's something that I think a lot of investors don't really appreciate, who haven't ever had to do that before. It totally sucks, and you never forget it. And it's one of those things that, when you're tempted to push the bounds on valuation, I just try to conjure that image again, that emotional feeling, and use that to try to temper our judgment. So we try to stay early. We think that's where you're going to have consistency of lower valuations. And it's also where our advantage, I think, is most pronounced relative to our domain expertise, because we believe that we can identify some of the risks early on and effectively select away from some of those risks, so that what the companies that we are investing in at that seed and A stage, we feel comfortable are not going to steer down some of these blind alleys that might otherwise destroy a company. And so from a probability weighted perspective, they're better suited. And so far, we've not had any companies go out of business that we have invested in. It's going to happen at some point. There are definitely some companies that we've had a couple of down rounds. But by and large, I think we have been fortunate in selecting companies that have, stood the test of some time at this point. And we have made a few later stage investments, but that's really the exception and not the rule. And in general, when we're doing those, it's because we've built conviction, having watched them for a while and seen them perform. And there's an opportunity for us to add some value, and that's the wedge that gets us into the deal.
Yeah, no, got it. And what would have been, the top 2 or 3 investments then, in terms of exits, or in terms of how things have panned out for you?
From an IRR perspective, you can't beat Granular. That was a deal that we invested in and was acquired 2 years later for $300 million by Corteva on about $1.5 million of ARR. So it was something that, they just identified a need for a digital team and a product that was on the right track, and they were willing to pay pretty far forward for that. So that was just a phenomenal IRR and a very nice multiple as well. And for us, it was really well timed early in the fund's life cycle to help kind of validate that the strategy made some sense. So fond memories of that deal. And Sid Gorham continues to be a friend of the firm and an advisor to us. And we talked to him quite a bit. More recently, Greenlight Biosciences went public in February of this year, and despite all of the SPAC turmoil, has managed to hold its ground from a valuation perspective. So that went out at about a $1.2 billion valuation, and we led the Series B in that company as they were pivoting away from biofuels to ag, biotech, crop protection products. And I have so much respect for that team and what they have built that's I think it's one of the most exciting portfolio companies that we may ever be associated with.
That's great. That's great. And tell me though, from a SPAC viewpoint, what was different about them compared to some of the other SPACs that kind of dived, as it were?
I think in particular with Greenlight, they have two elements to the business. They have a crop protection side of the business, and they have a human health side of the business. When we underwrote the deal, the human health side didn't exist. They had a platform for producing RNA, and they could do it at high volume and very, very low cost. And that was going to be incredibly useful for crop protection, where they could create double-stranded RNAs and target pests in a very specific way with effectively no off-target toxicity. That's a huge deal in crop protection, because that's where the market is going. It's away from small molecule, broad spectrum synthetic chemicals to much more specific, bioproduced type solutions. They discovered about 6 months after we invested that they could cap and tail that RNA and make mRNA, and then suddenly the world became interested in mRNA, and that has become a really interesting side of the business. So I think it's sort of the dual threat opportunity that has captured a lot of attention, both from investors interested in the sort of sustainable ag side of things, but also from a human health perspective, because not only can they do mRNA vaccines for COVID, but for flu and for shingles and for gene therapies. So there's a huge market opportunity available to the company, and they've done a very nice job since going public of having made a series of business development announcements, including with the Serum Institute, the largest vaccine producer in the world, doing a deal with them to co-develop a shingles vaccine and two other candidates, and then a couple of other announcements that have sort of kept the world on their toes. Okay, this company is executing. It is living up to what it said it would do. So I think that is what they've been able to continue to communicate good news since the offering. Still early days. Still lots of challenges ahead. There's still no revenue in this company. That I think has also been one of its advantages, is that there isn't a revenue execution expectation in the short term that they're going to fall short of, unlike a lot of companies that have gone public and then said, oh yeah, we're probably not going to make that, supply chain issues or whatever they may be. So that I think is it's a broad definition, but none of these SPACs, we're in Benson Hill that went public in Q4 of last year. And then Planet Labs, and both of them have been pretty well hammered in the public markets, but it's on effectively no volume, right? So there's no institutional trading going on in these companies. It is very small volumes of retail shares that are moving prices all over the place. So there's just not a lot of signal. There's a ton of noise, and really we won't know how the markets truly value these companies until we get a couple of years out where they've been reporting on a quarterly basis and they've either lived up to what they said they were going to do, or they don't. And then you're going to see the institutions who bought into the pipes and who have been sitting on the sidelines waiting to see what's going to happen. They'll make decisions. That's going to define long-term value for all these companies. It's kind of a red herring to be looking at short-term stock prices.